Go ahead.
Okay, so the alternative signals project, the original goal is to create a systemic algorithm for detection of a signal. So that is coming from, that can affect company market data and fundamentals. And so basically, the goal of this project is to identify one of these data sources and then make a market decision based off of that. Here we go. So some of the considerations that went into this project is that we had to be able to distinguish market signals from individual stock runs. So this is to make sure that if the stock price goes up or down, that it's due to the signal detection and not from a systematic movement in the market. And because of that, we to use alternative data sets to generate signals. And this is so the incorporation of other data sets into the signals kind of leads into the time series forecasting, which is a mathematical tool to help you predict and like kind of analyze future stock market movements. So the plan is to kind of combine both of these tools to use time series forecasting as a predictive tool for pairs trading. So, oops. So one of the issues is that the T statistics used for predicting outcomes or future movements were too small to give an accurate confidence interval. And the correlations were extremely weak between stock price and web traffic and Facebook hits. And kind of going off of this, one of the things that I think we look into the future, especially after our conversation with Omri, is instead of having a data source and finding market insights from a specific data source, I think the better option would be to go to work backwards from it. And drawing off the example of Netflix, when the stock price plunged, I think it wouldn't be too difficult for an analyst to realize that the stock price is highly dependent on the number of subscribers. And so then it would have a huge impact on the stock price. And so looking forward or moving forward with different stocks and different data sets, I think it would be best to work backwards and find out what influences the stock price and then try and find data to support that. The other angle to this project is the pairs trading. And this is pretty widely used by fund managers and has many different applications, but it's based around the premise that you're expecting two prices on correlated securities to price fluctuations within the market. And at some moments, a security will be trading at a lower price relative to another. And Professor, is there an issue?
No, I could hear you.
It says my screen sharing was paused.
No, it's not.
Oh, okay, cool. No, we're good then. So looking at the graph on the top right, you can see how you'd buy the lower price security, then you exit the trade. And the graph on the bottom right actually shows how that application worked in real life with Amazon and Etsy stock prices. And this kind of gets into the back testing. So I tried out this strategy using a pretty rudimentary signal where once the stock prices go beyond a certain spread threshold, say like 5%, then you enter into a trade. And once the threshold gets lower, say about 1% difference, then you close out the trade. And pretty interestingly, this yielded really strong returns, almost 30%. And one of the advantages to this process is that it doesn't result in any market risk in the trade, because every single trade that you're taking is hedged by another correlated security. So the actual risk in this process is the risk of individual stocks trading, or either losing a ton of value or gaining a ton of value in a pretty short amount of time, which can be managed through kind of risk management practices or techniques. Oh. And so moving on with this project, I applied the pairs trading strategy into a live algorithm. And this works off of real-time market data and sends trade decisions to an order book, which would typically be on Excel or a data frame on Python. And this is best. And it's something that's that can be added onto in the future. So if we are able to find out more insights from market data, that data can very easily be incorporated into the main loop of the algorithm so that it adds more conditions before the trade is actually executed. And hopefully this improves the efficacy of the decisions. Or so with this project moving forward, I think time series forecasting can be a very powerful tool, and the live algorithm is already in place, so we can easily accommodate methods to implement more forecasting models. So with that said, I think there's a lot that can be added, and the algorithm is already in place for kind of like new techniques to be kind of experimented with. And with that, I think we can test time series forecasting with different data sets or work backwards with companies to find out what specific insights would manipulate the price. And then we can implement risk management systems into the trades. And we can also use an API key to trade on brokerage platforms directly. So that would allow Python to access legitimate brokerage platforms, so you can execute paper trades or real life trades. And then kind of the last note is that finding the right data can be just as important as the analysis, and knowing what doesn't work is equally as important as knowing what does work.